My next guest called that Bostic headline that just crossed. Joining us now for more is Diane Swonk. She's the chief economist at KPMG. Our senior economics reporter, Steve Liesman, is standing by as well. Diane, you thought they might skip here.
Well, I think it's a possibility, and I'm not at all surprised that Raphael Bostic has said that. He has been a more hawkish member of the Fed, and we know that Chairman Powell really worked hard to corral the cats on that outsized cut, and the market was front-running the Fed. We expected 2 quarter-point cuts. The market was well ahead of that, and we still expect 2 quarter-point cuts, but the situation now is just, highly noisy. To put at the very least, we've got disruptions due to the hurricanes that could push up prices. The Fed could look through that. Supply chain disruptions as well. At the same time, we've already seen layoffs due to the hurricanes in North Carolina in particular pick up, showing up in the unemployment claims. The October employment report, which comes out November 1st, right before the election, is now set up to be really, really weak because we also have this strike in the aerospace industry and spillover effects to suppliers also holding down those numbers. We know after major hurricanes, we tend to see somewhat weaker payrolls in the month following that. We're also going to see, because of the timing of this, the number of workers who are unable to work due to bad weather likely hit a new record in the month of September. The previous record was 1.9 million in 1996 January when a blizzard hit the East Coast, including Washington, D.C. The second largest record was right after Katrina. And I think that's sort of where we're at right now, given just the number of people who were actually asked to evacuate or shelter in place. A lot of that shutdown is going to be reflected in the employment report and could show up as a rise in the unemployment rate, much like we saw from Hurricane Beryl back in Houston. So that's a lot of noisy data. Right. But I think at the end of the day, the Fed will get to it. The 2 cuts, but not more. The market was ahead of them. And you really do see that hesitation, which I think is where the debate should be right now.
Steve, it makes me think that perhaps the labor market data actually take a back seat to inflation. I think the CPI today becomes even more interesting. We know a natural disaster is not going to be disinflationary in the near term. It's going to drive up prices and maybe cause some stickiness. The point I'm trying to make is if jobless claims go up, if the payrolls disappoint, normally you'd build in a stronger Fed reaction function. And it sounds like that we're not going to do that this time.
No, I don't think the Fed's going to tolerate higher inflation. But again, if it's related to the hurricane, the Fed is going to look through that. And I think it's going to look through the strike data. It'll probably look through the weakness in the employment report. It's going to be really hard to tease out the trend given all the distortions that are coming our way. There's some calculations that were done. A lot of the rise in the in jobless claims today was related to the Boeing strike, as well as the states that were hit by Helene. Now you have Milton coming along. And of course, our hearts go out to all the people who have been affected by that. But one thing, Diane is so nice. She says herding cats. I was thinking about other Fed officials I've seen to see if their arms were in a sling, because it looked like there was arm twisting going on at the last meeting. So I just, Diane is very nice, but I think there was some arm twisting going on. When you have a statement in the minutes that says some wanted to do 25 and a few, I guess the way to think about it is, would have gone along with it if that was what was on the table. So they wanted to start big, 50, and I guess now the thinking is it's going to be meeting by meeting. I still think the Fed has some. It could take off the top and still be okay here without losing the fight against inflation. We had Williams say today the Fed is still going to be restrictive after it takes off additional rate cuts.
Wait, but Diane, do you know what I'm saying? It's going to be a bit odd for the next month or so to watch weaker data not necessarily met with a stronger Fed reaction function in terms of more rate cuts. I think that it's going to be interesting with the election coming up as well.
It is, couldn't be, worse timing coming up to the election with all this noise, but it is noise and the noise is deafening. But the Fed, I agree with Steve, will look through some of that. What is encouraging right now is that we have seen big supply chain disruptions, and those supply chain disruptions prior to the hurricanes not show up as increases in prices and pass through like we had seen during the pandemic. Of course, that was an extraordinary period, but that we've seen companies be much more nimble and actually consumers push back much more. The combination of the two with productivity growth means that we've not seen the kind of pass through that we did earlier in the recovery. That's the good news, but the Fed's going to be watching that very closely because any sort of stickiness they see is even with, they're going to look at what are the things that are hurricane related, what aren't. That's going to be tough to tease out.
Yeah.
I was encouraged by one thing, and that was that shelter costs came down, slowed down quite a bit in the month. We have to see if that's sustained. That is one area that also could get some upward pressure, of course, by the hurricane. Everything from hotel room rates to rents could see some upward demand,
and we're seeing
in the result of the hurricanes.
Absolutely. The markets, they have pushed the 10-year back up to 4.11. You know, we've got stocks kind of wobbling towards session lows as well, even as we're talking about normally you skip a November cut because the economy's doing well. So for now, folks, we'll leave it there. Thank you and appreciate your time today. Diane Swonk, Steve Liesman.